Hello everybody, here from Hamburg. Today our topic is the focus on China, and today with us is Rowan Francis from Tamac Asset Management. Rowan is the head of asset management and comes today directly from London. Rowan, welcome here in Hamburg.
Hi Henrik, good to see you.
Good to see you again. At the moment the topic of China is really heated, and we saw a lot of policy and regulations in China. Can you give us a short overview what's happened in the last 3 months?
Yeah, absolutely. Well, it really starts going back to the beginning of last year, so 12 months ago. China came in quite hot. Their economy was recovering nicely from COVID. And they started by tightening liquidity to ease inflationary pressures as they saw them 12 months ago. That was the start of a turbulent year for China. They then increased regulation, starting with the educational sector, moving into large cap technology space. So what China want to do is look after the average Chinese. That's their goal, to improve prosperity.
So the regulation goal is for the average Chinese.
Exactly. You have to take their standpoint from a logical point of view. They want to protect their population from anything they see as untoward, essentially. So with large cap technology, where they have these large monopolistic businesses, they did really what the rest of the world, or what the US would like to do with their tech majors, and bring in regulation that helps to stymie what they're doing in certain areas. So that, on the short term, has a negative impact for those businesses. It does have an impact to the bottom line for what they're doing. But in the long term, it's not a case for us of the Chinese authorities trying to disband those businesses. They're just trying to regulate them in a way that is keeps them as a going concern, keeps their population happy, and doesn't exploit anything too much. So
this is a good point. So you will definitely recommend to invest in the long term, definitely also in tech companies in China.
Yeah, so no question, technology in China, or technology globally, the innovative growth that you get from those areas, there's no doubt there. What China are doing with a large cap tech is not trying to break them up. They're aware this is a big growth driver for their economy, and that's an area that they need. That sort of domestic consumption and innovation, which is driven by those tech majors, is hugely important. But what they don't want is the businesses to become bigger than the state. And in those instances, they were. So what you've had is a huge drop in valuations of those tech majors, partly for good reason, because you do have an impact on profitability. We've seen that, that's very clear. But what it doesn't do is change the growth dynamic for the full areas of the businesses that they express.
Yeah.
Exactly. Yeah. And so you actually have, even taking into account the discounts that you should place on them because of regulation, those businesses trading exceptionally cheaply now versus history, and also versus where they're going to be growing to.
Yeah, that's a good point. That's a good point. Also on every news are the construction company Evergrande. So this is always in the newspapers. Do you think that these can lead to a Lehman moment, like in the US in 2008?
So no, is our view. Again, what they did last year when they started tightening liquidity, Chinese authorities, partly to cool inflation and to cool the housing market, which was an area of concern for them. So that's it's a big growth driver for the economy, but an area where there was a lot of leverage being employed. So what the government effectively did is make it much more difficult to borrow. What that did is, for companies like Evergrande, destroy their revenue model for last year. So you saw revenues drop by 95% for that sector. Obviously, if a business has got a lot of debt, suddenly has a big revenue cut, you're going to get into financial difficulties, which is where they are at the moment. It was sort of instigated by the Chinese authorities. So the first point to note is that it was caused by that regulatory shift. And what we've seen already in 2022 is them starting to walk that back, making it a bit easier, financial conditions a bit easier. So that's one difference. Lehman and how that came about was sort of natural progression of a market that grew into a bubble, and then the bubble just popped. This is Chinese authorities intentionally cooling it before they feel it's getting to a popping stage. The second is size. So Evergrande's maybe 300 billion's worth of debt. If you take Lehman, was maybe 600 billion at the time. The system was much more over-levered outside of Lehman in the whole financial sector. This is property specific. And in China, they have more levers, so they have a less indebted government already, so they have more levers to protect against that fallout. And they also have the ability, I make the point, when Lehman went bust and the Fed had all the bankers around the table, and they said, who would like to take on the burden of this debt? And basically nobody did, and they went bust. When China sit their insurance companies and their big state-owned banks around the same table, they don't ask, they tell you who's going to take that debt burden. So that sort of dissipation of where the risk sits gets spread out much more quicker. So they can deal with the sort of fires quicker. So that's not a great growth sign for the financial sector in China, for property developers. It doesn't mean that you're just over the risk. It's an area that we avoid. But it does mean that it should stop it becoming systemic and going further sort of throughout the economic system.
Okay, so in the midterm it could be anything okay with Evergrande, of course, also.
Yeah, so I say, as a medium-term growth headwind, certainly. As a systemic threat spreading further out, for us, we don't see that as a highly likely event at all.
Okay, that's good news. In the last years, of course, also you have the conflicts between the US and China on the trading war, where you still see there the problems and maybe also the prediction what's up next, and maybe there's also
it's what you've got is two superpowers
who
are both growing, and for our lifetimes they are going to be at loggerheads with each other. That for me there is no question. You're not going to see just smooth relations always. You don't see that with superpowers and when they rise. The point that I make is the world is big enough for both to grow. You have the Asia-focused world, you have the US-focused part. So growth and togetherness, just growing together doesn't work, but growing separately at equal paces, that can still be something that is more than achievable for sort of global good as well. But if I said where we are in the medium term, so we've just had a year where really the trade war hasn't been a focus. My expectation in the next 12 months or 18 months is, again, we see that come back. We've had COVID, that's been a big issue. When growth normalizes, and it will, we'll come back to these concerns. The point for me is you can grow through that. The two superpower economies, as long as we don't have a huge coming together that goes past just an economic spat, then global growth is enough to support both economies in a sort of functioning fashion.
Okay, that's good. So you're really a specialist for China and are really into the topic. The final question is, and also the deciding question is, what is Tamac do to avoid these political and regulatory risks on the side in your fund, for example?
So we are a growth-focused China fund. That's what we like to consider ourselves. We invest in champion businesses. So our big focus is to buy a business that is a high-quality growth business in an area that's growing. So we naturally avoid the typical state-owned areas. So in finance, in utilities, energy companies, things like this, where the innovative growth aspect generally isn't there and where the quality of business is much lower. So just the natural process of our selection, which skews us more towards, say, technology or consumer-focused businesses, helps us avoid those state-owned, over-indebted companies. The debt to equity of our portfolio is less than 30%, which is significantly lower than the broader market, not because we intentionally are just targeting lower debt companies, but because our businesses have organic growth where they're not needing to take on that financial leverage. And so that's a huge benefit in sort of helping us avoid areas like property, which are going through particularly tough times.
And you just explained the process, and this process is also the same for your other strategies, right? Also.
Exactly. So our goal is always to buy a champion business or a high-quality, growth-focused company in whichever sector. We like thematic investing. We think you can go to certain areas, and those areas over decades can be outperforming. China is one of those geographic areas, but in the green technology space would be another. In technology, new technology innovation is another. These are huge areas where opportunity and innovation are sort of accelerating. And if you can buy the best companies in those areas over time, then you're proven right, at least when it comes to returns.
Perfect. Rowan, thank you for the first
time
here in our studio. Thank you for the overview in China. We will have another videos with Rowan in terms of other topics, but also on China. And see you next time.